All right, I want to welcome everybody. For those of you I haven't seen on the call in a while, I hope all is well. Some of you I know are recovering from injuries, so hopefully that's not too unpleasant. Some of you have just gotten back from some very nice trips, so hopefully that was awesome. And some of you are going on some very nice trips. So glad to see some familiar names on the call. And some of this content might seem familiar, redundant. I wanted to mix it up because I've been talking about, the market the last few weeks, and, it's a little unsettling right now, right? I mean, the volatility, the gloom and doom, have some folks that are approaching retirement and extremely nervous, and, rightfully so. It's scary times to go in and watch some of your account values evaporate, for lack of a better term. And we're going to talk about maybe next week some other ideas, but today one of the things that we have to start to focus on is taxation. So if you've not been on this call before, typically what I suggest is just sit back, relax, take notes. If you have questions, circle back, reach out to me, happy to help. But this is a conversation that my partners and I teach and train some of our advisors over the years. And when it was first built, the Excel spreadsheet, it really was eye-opening, because at the end of the day, the math doesn't lie. Without further ado, let's go ahead and get started. So, this will be audience participation, and there is no right or wrong answer here, but I'd like you to type into chat right now if you think income taxes in this country will be lower, the same, or higher. Let's just see what some of the responses will be. So we got a higher, we got a higher, we got a higher, and I would concur. I don't have a crystal ball, but based on everything I see, I would agree. So if that's the case, right, has anybody on this call, I know a few of you might have seen this calculator. There is a lot of data on here. This is actually a real running time clock called USDebtClock.org. You can go there right now and it's running real time. I take a snapshot periodically and help folks take and interpret some of this data. Now, when I first started showing this to folks, it was back in 2005, 2006, and the US national debt, which is in the upper left-hand corner here, was at 5 or 6 trillion, that's with the T, dollars. Fast forward 15, 17 years, and we are at 30 trillion. All right, so we've spent a lot of money in the last 1.5 decades. However, that's not all the debt. This is the total debt that each of us as US citizens owe collectively. That's approaching 90 trillion. Some of that is unfunded liabilities, whether it be Medicare, promises made by the government, Social Security, whatever that is, but that's part of that overall general number. But here's a number I find interesting. It's 4 trillion. This is all the taxation, the tax revenue the US government collects to balance the books. So you don't need to be a math major to understand that our government has a spending problem. And they keep kicking the can down the road and expecting our children and our grandchildren are going to have to pay this debt in the future. Now, again, I agree. I don't have a crystal ball, but it can't continue this way. At some point in time, the piper will come calling. But for now, and part of where the reason for the conversation, the horse race, is because collectively, us as US American citizens have said, you know what, let us all save money in different types of accounts. So does saving retirement in tax postponed vehicles like IRAs and 401ks make sense? I mean, when they were first created, you have to understand why they were created in the first place. And back when the 401ks were first created, most corporations had pensions, companies were rewarding employees for a job well done, and they would offer them lifetime incomes, basically an annuity, for their services. But what started to happen is it becomes very, very expensive, and the penalties for not meeting your contractual obligations was costing a lot of these corporations significant amounts of money and penalties. So the creation of shifting some of that burden to the US populace became mainstream. Now it's everybody's like, brand new out of college, and you go get a job, and first thing they promote is a 401k. And what were we all told by our HR department, or when we went in and filled out paperwork, is, hey, put money in the 401k, because when you get to retirement, you're going to be in a lower tax bracket. And so we fast forward 10, 15, 20, 30 years. Is that in fact still the case? Well, I could argue that the rules have changed. Now, this is just something, it's not how much money do we end up with. This is one of my clients that I have been dealing with, and they're really, I think they're about 47, and we projected out on their current run rate, putting money into these qualified plans, that's a 401k or IRA. It's not how much money do you end up with, it's what did it cost you to get there. And they're on track to pay the government, $6 million over their life expectancy. So, it's still a projection. It's not guaranteed. And that's not even if they raise taxes into the future. And that's why you'll hear me talk about tax risk. But let's apply math with the horse race. Let's not take a jaded or skewed approach towards the reality, right? So I try and be fair with my assessment. This is a calculator my partners and we built when we're training advisors, and there's a lot of information here, so I'm going to go through it. There's 3 horses are going to be in this race. There's a blue horse, there's a yellow horse, and there's a green horse. And we're going to treat each of those horses the same by contributing the same amount of money into each of the 3 tax environments. And we're going to give it each account the same crediting rate. So $10,000 is what's going to go in for 20 periods. And then in 20 periods, we're going to withdraw from each of these accounts $67,275. Why that amount? Because that's the amount of money to exhaust the Roth IRA, right? So this way it's fair. We're going to give each of the accounts a 10% growth rate in the accumulation phase. And then we're going to pull the money out. We're going to put it in. We're going to tax it at 20% if it's taxable, or we're going to take it out and we're going to tax it at 20%. So either way, it got a fair shake. So 20% on the accumulation portion of it. So going up the mountain, we tax the accounts at 20% unless they were tax deferred or tax free. And then we tax it on the way out at 20%. So what you'll see here is that it mathematically, the IRA, 401k, and the tax-free, whether that be Roth or some other type of tax-free environment, mathematically it's a tie. They end up to the exact same amounts. That's if taxes stay the same, we're able to withdraw the exact same amounts, whether it's in a 401k or in a Roth-like vehicle. So that should first tell us that, okay, so there's no real distinct advantage. But when I asked the question at the beginning of this call, did we think taxes were going to be higher in the future? A large number of you said yes. Well, if that's the case, what does that look like? We're going to explore that. But before I do, one of the less obvious, I think, results that jump out at me is the blue horse. A lot of folks, when I'm sitting and looking over their accounts, and I get it, right? They got money that's in a brokerage account, it's in a CD, it's in some type of environment where they get something called the 1099 INT every year, or a 1099 DIV every year. Well, notice as that blue horse is going through the accumulation phase, it's not growing as quickly. And that's because the money to pay the taxes has to come from the account in order to pay the government along the way. So in order to be able to pull the same amount of money the blue horse runs out of money the quickest. And that should just be an aha moment for everybody on this call, that the least expensive or the least efficient way to save money is with the blue horse or a brokerage account or some type of tax annually type vehicle. So now we're going to turn around and say, what if the people, the HR department, the people that had to sign into to the philosophy that we're going to be in a lower tax bracket when we retire? And this is quite often the CPAs of the world, the accountants of the world. This is usually the Kool-Aid that they drank from. And I get it, right? This is how they were trained. They said, well, we can't anticipate what the tax environment's going to be. I would beg to differ, but if you follow that philosophy, and there are times when I see people very high income earners, if you're earning $400,000, $500,000, $600,000, $700,000, yes, you can make the argument that you may not be in as high a tax bracket when you actually hang up your cleats. However, the average middle class, even high income earners making $200,000 or $300,000, $400,000 are probably at risk here. But let's look at the math. So we're putting in the same amount of money, but on the way in, we just gave it a 10% rate hike on the way in. So we just taxed that at just a little bit more at 10,000. But when we retire, at 30%, we tax a little bit more at just a 10% increase versus going 20% on the withdrawal rate. So now who wins? Well, in that case, all the pundits, all the theorists, right? Absolutely correct. When you retired, you were earning less income, and therefore we paid less tax on the way out, and we ended up with more money in a tax-deferred plan. And that's the perfect scenario. Okay. So if you're in taxes or in a lower retirement, IRAs, 401ks, and TSP win. However, and I don't have these slides here, but I've shown them in the past as some of the tax history. We're right now, as much as we talk about taxation, we're, historically in one of the lower tax arenas that we've been in since the inception of the income tax. But let's look at the last one, which is what a lot of us felt or feel is likely to come in the future. And that is, what is the tax environment if we're actually 20% on the way in, but 30% on the way out? Well, now tax-free wins, and handedly. So if taxes go higher, tax advantage wins. And this is why we should be taking steps while we're younger to start to unravel, or what I call divorce the IRS along the way, to reduce some of this future tax risk. Now, I got one more slide here. Arguably, one of the smartest men to ever live said one of the hardest things to understand in the world is the income tax. And I talk to folks all the time, and quite often they'll get the deer in the headlight. Well, that being said, when you break it down and just look at it mathematically on some of the calculators that I use, it's not that hard, but I try and simplify it. I just say, look, if we're married, filing jointly, what used to be is a graduated cylinder to the left side of the screen. And basically, not every dollar is taxed at the same rate. So depending on what your income in 2017, that's what our tax environment was pre something called TCJA, the Tax Cut and Jobs Act, right? When the last administration put that into place, they created the graduated cylinder to the right. And that is our current tax environment. However, there's some red numbers on the upper right-hand corner on 1/1/2026. This is already law. This is going to happen. And one of the things I do when I'm sitting down and looking at folks' income levels, I say, hey, here's where you currently are. You might be at the 24% marginal tax bracket or 32% marginal tax bracket. But depending on, on that date, 1/1, their income, we are absolutely already factually, and this is going to happen. It's going to revert or sunset back to what the graduated cylinder is on the left. That's going to happen on that date. So even if you were earning the same amount of money, you think about it, if in my example on that screen, if you're making $250,000, you're in a 24% marginal tax bracket on the right side. Well, you automatically you go to 250 on the left side. That's a 33% tax bracket. That's a hidden stealth tax that a lot of folks are not even aware of. So part of strategies that I promote, some folks that I've worked with in the past, they get it. We're trying to slowly unravel this tax time bomb that we've created, so that we can reduce that implication. And there's other factors that's more complex than this, but I wanted to just have a simplified view or a conversation today about what to expect on a go-forward basis. So, that is just sort of a summary, the horse race, why we should be thinking about. So some free financial planning advice. If you're still at work and your employer offers within your 401k a Roth component, think seriously about contributing to that portion of it. Understand that if they match, whatever that your corporation matches will go into the tax deferred bucket. But all your contributions will pay tax this year, but it will grow and compound tax free. And that's a step in the right direction. So, this is our disclosures from RIA. I hope you found this conversation at least a little bit enlightening and insightful. If I haven't spoken to you lately, please reach out, say hello, let me know how you're doing. And I want to wish everybody on this call well, and I look forward to seeing each and every one of you or talking to you soon. Have a great day. Bye-bye.